Management accounting for micro and small businesses companies. Welcome to this channel. You are on the Flor de Ouro channel. Malik Casanova. I wish you learning and extraordinary experiences. Article recorded on March 16, 2023 by Sybil Mann-Baylor for educational sharing in Flor de Ouro. Douglas Lyman Jose, Bachelor of Accounting Sciences, Faculty POYNS FAP. Augusta D. Rodgeflowers Theras, 2 Professor at UFPI/Master in Financial Administration, UFPB. Management accounting for micro and small businesses companies. Focus on economic indices and financial. Summary. The present work with the subject managerial accounting for micro and small companies of focusing the analysis of economic and financial indices aims to show the benefits of using analysis of financial statements in the balance sheet and income statements of the DRE exercise in micro and small companies. To fulfill the objectives, the study was carried out theoretical and documental, based on specialized books in this area, production of theoretical works, the reading of some works, and, from that, to make the summary of the thought of the consulted authors, where one can come to the conclusion that, through managerial accounting using the analysis of financial statements, it is possible to know better the real situation of the companies, to make them more strong and competitive, making decision-making easier for entrepreneurs. Keywords: analysis of financial statements, management accounting, microenterprise. 1. Introduction. In Brazil, the vast majority of companies in activity are made up of micro-enterprises and small businesses that are of vital importance for the economy of the country. These companies are great job and income generators, contributing significantly with the increase in the gross domestic product (GDP) in Brazil. However, usually these companies do not adopt an information system capable of to assist in the development of the business, and as a consequence many end up closing their doors in the first years of life. Many micro-enterprises use accounting only as a way to keep up to date with the tax authorities, failing to benefit from the many or countless information generated by accounting. Make their investment and financing decisions based only on intuition, and its results often fall short of expectations. Accounting has the primary function of providing concise and accurate information, safe, so that decision-making by entrepreneurs is the right one possible. This information should be part of the company's routine to serve as support in any and all decisions to be taken, regardless of the size of the company. The financial statements are extracted from the reports provided by the accounting, after all the records pertinent to them, and their analysis is vital importance, as it aims to maximize the company's wealth, guide entrepreneurs in the processes, decisions regarding investments, credit operations, purchases, etc. A fact that denotes the relevance of this study. With the present work it is expected to contribute with the users of the information accounting, managers and administrators, offering solutions for the search for the maximization of profits, provide a more detailed view of companies in the financial and economic area, educate entrepreneurs about the limitations and potentialities of their companies, so that in this way, they can make the most correct and safe decisions, and demonstrate the importance of making decisions based on the analysis of the financial statements of their companies. Through the balance sheet, which is an accounting statement that aims to show the financial and equity situation of a company on a given date. Information can be extracted regarding the financial position of the company in a given period. The income statement for the year DRE is a report summarized, which contains all income and expenses ordered according to their nature, and one of the most significant values for entrepreneurs, the net profit for the period, thus providing significant information about the company. This work seeks to promote the research, to find out about the benefits offered to micro and small companies, through the analysis of the balance sheet and the statement of income for the year, referring to profitability, liquidity and indebtedness. 2. Managerial accounting. While financial accounting is more concerned with complying with standards regulatory bodies, management accounting is concerned with providing information, useful and practical tools for decision-making, seeking to adapt accounting reports to needs of each company. Santiago 2006 p.24 says that the search for safer mechanisms with less risks lead institutions to implement planning. Planning emerges as a supporting company decisions. In an environment of uncertainty, it is necessary to have a good planning in order to maximize the possibilities of success in the decisions. The small entrepreneur can benefit from the accounting information in his company, so that their decisions are taken safely and consciously, based on information that will maximize the chances of success in your decisions. 2.1 Application of managerial accounting in micro and small companies. Small companies are often devoid of accounting support in their administration, since most accountants only comply with tax obligations and assistance that the legislation imposes, but do little or nothing to help the administration of these companies with useful information for their planning. According to Silva 2002, p.23, a company without accounting is an entity without memory, without identity and without the minimum conditions to survive or to plan their growth. The correct recording of facts that occurred during the life of company serves not only for its management at the present time, but also serve as parameters for future comparisons. For Oliveira 2005, p.36, management accounting provides clear information, precious and objective for decision-making, as a support on which micro and small businessmen will rely in their decision-making. Management accounting can become an indispensable tool to companies that want growth. For Share 1991, p.47, the basic inputs for the use of indices are the income statement and balance sheet, both prepared by accounting. For a correct analysis of the indices, the accountant must know the company that will be analyzed so that it can emphasize the most relevant accounts and so that it can be analyzed do not become distorted by misinterpretations. To get an idea of the importance of analysis based on financial ratios, just mention to whom such an analysis is of interest. First, and obviously it interests the administrator, insofar as it provides the necessary instruments to verify the operation of the company, applying, when necessary, corrective measures to remedy any problems detected. It is also of interest to the company's creditors, concerned about its ability to honor obligations on the dates of due date. Finally, it is in the interest of all those who invest in the company, concerned with identifying the degree of risk of their investments. Share 1991, p.48. With the analysis of the financial statements, the administrator will be able to make decisions based on consistent and secure information. which will increase your chances of success. The financial statements allow a real follow-up of the dynamics of the business, making it possible to set new goals and guidelines in a timely and safe manner. Accounting statements that can be applied to micro and small companies are the balance sheet, the income statement and the cash flow statement. Cakes, in this case, should be prepared in a simpler way, taking into account the small financial movement of these companies. You are on the Flor de Ouro channel. Malik Casanova. I wish you learning and extraordinary experiences. Article recorded on March 16, 2023 by Sybil Mandler, for educational sharing in Flor de Ouro. Like and subscribe. 3. Financial and economic ratios. As far as financial analysis is concerned, financial ratios are of fundamental importance. Because they will be the ones who will provide the necessary information to the entrepreneur, and this in turn, it will make use of these indices that will benefit its administration. The economic financial indicators are the elements that traditionally represent the concept of balance sheet analysis. These are mathematical calculations performed from the balance sheet and income statement, looking for numbers that help in the process of clarifying the understanding of the company's situation, in its equity, financial and profitability aspects. PADOVSE 2009 P.208 Science and Business Study Notebook, Terracina, Year 10, then July 1, 2013. The management accountant can and should use index analysis techniques to help in the development of companies, whether small, medium or large, as each company has its potential, and with the correct analysis of these indices they may become great powers. These indices are very useful for measuring the economic and financial position and performance levels in several aspects, because, according to CREPALBI 2009 P.208, the basic objective of the economic financial indicators is to show the current situation of the company, while trying to infer what can happen in the future with the company, if that situation detected by the indicators has a sequence. There are several indicators that we can extract from accounting reports. However, it is much more useful to calculate a selected number of indices consistently from period to period, and compare them with pre-established standards and try, from there, to take the idea of which problems deserve further investigation. According to Padovi's 2009 P.208, there is no need for many indicators. On here, it will be demonstrated, the liquidity indices, the indebtedness indices and the profitability indices, which are the simplest calculation indices, as they do not require a great deal of detail of information. 3.1 Liquidity ratios. Ability to pay ratios measure the company's ability to pay its debts in the long, medium and short term. They are current liquidity, dry liquidity, liquidity, immediate liquidity, general liquidity and indebtedness. Table 1. Current liquidity. Source: own elaboration. 2013 Current liquidity equals current assets / divided current liabilities. End of description of Table 1. The purpose of the current ratio is to demonstrate the company's ability to meet your short-term obligations, suppliers, rents, payroll, etc. Table 2. Dry liquidity. Source: own elaboration. 2013 dry liquidity equals current assets minus inventory divided / over current liabilities. End of description of Table 2. As illustrated above, this indicator has the same objective as the previous one. It shows more clearly than the ability to pay since it removes from its calculation the stocks that have not yet been sold. According to Menagment 2006, P.89, it must be analyzed in conjunction with other indices as it is quite conservative, so that only with it can be analyzed the financial situation of the company. Table 3. Immediate liquidity source. Own elaboration. 2013. Immediate liquidity equal to available resources such as cash, banks, financial investments, over/ divided by current liabilities. End of description of Table 3. According to Table 3, immediate liquidity is the financial indicator that demonstrates more clearly the ability to pay in the short term, as it considers only assets funds effectively available to be used in the execution of any payment. It is known that current liabilities, as part of the company's core activities, in many companies may be much greater than their availabilities. According to Pazzolito 2008, PAD exaggerated emphasis should not be attributed to this quotient as significant and imminent financial disaster for the company, in the opposite direction. That is, at the upper limit, question is often asked about its suitability. The company must always keep cash to face immediate expenses, but the high accumulation of immediate liquidity can cause damage to business activity because according to Pazzolito's 2009, P.214. However, an excess of immediate liquidity can harm profitability, since usually the sale of products and services of the company's operations give more profitability than investments in the financial market. Thus, expressive values held unnecessarily in cash undermines the overall profitability of the enterprise. So that there is no lack or money stopped in the company, it must be verified which capital needed to run the company in a certain period of time so it can be done an average forecast of the amount of money that must always be available to cover these expenses. Table 4. General liquidity source. Own elaboration. 2013. Overall liquidity equals current assets plus long-term receivables over/ divided by current liabilities plus long-term liabilities. End of description of Table 4. According to Table 4, the general liquidity index demonstrates the ability to now long-term payment, considering everything that can be converted into cash, listing all obligations already assumed. 3.2 debt ratios. This group of indices shows the entity's financial situation, seeks to point out the great paths for financial decisions in terms of obtaining and applying resources and as well as the level of indebtedness. Table 5. Indebtedness source. Own elaboration. 2013. Indebtedness equal current liabilities plus long-term liabilities over/ divided by liabilities. End of description of Table 5. This indicator must always be less than 1.00, as indicators greater than 1.00 may suggest excessive indebtedness of the company through loans and financing already contracted. It is an index that measures the financing structure of the company. For Menagment 2006, P.104, it is these indices that inform whether the company uses more third-party resources or resources of the owners. It is important to emphasize that the success of companies is almost always linked to the success of the financial administrators of the same, because a good management manages to achieve balance in the capital structure between third-party resources and own resources. In the analysis of this index there is a need, according to Menagment 2006, p. 105, to detect the features of the following indicator. Companies that resort to debt with a complement of equity to carry out productive applications in its assets expansion, modernization, etc. This indebtedness is healthy, even if it is somewhat high, since the productive applications should generate resources to pay off the assumed commitment. Companies that resort to debt to pay other debts that are due do not generate resources to settle their commitments. They resort to loans successive. If this vicious circle continues, the company will be a candidate for insolvency, consequently, bankrupt. It is verified here that there are two types of debt, good and bad. It's up to the administrator, financier or businessman analyze his debt capacity through two indices: complementary equity guarantee to third-party capital and the composition of the indebtedness. Third-party equity equal third-party capital times 100 over divided by shareholders' equity. Table 6. Participation in third-party capital source. Own elaboration. 2013. Interest in debt equity equal to debt capital times 100 over divided by shareholders' equity. End of description of Table 5. Here we can highlight how much the company uses third-party capital for each $100 of equity invested. The lower this ratio the better, because the greater it is, the greater will be the company's dependence on third parties, making its freedom limited decision. The purpose of the composition of debt is to identify at what percentage of the company's total debt corresponds to short-term debt. Table 7. Composition of indebtedness source. Own elaboration. 2013. Composition of debt equal current liabilities times 100 over divided by third-party capital. End of description of Table 7. The lower this index is the better. It means that having more long-term debt term will have more time available to seek resources to settle their debts in the future. However, if short-term resources are cheaper, the previous interpretation that the smaller the better it can be reversed. It is up to the entrepreneur to assess this situation. Equity guarantee to third-party capital (GCP) reveals the autonomy of the company. The guarantee offered by own capital to third-party capital. The greater this percentage, the greater the existing guarantees. Table 8. Equity guarantee source. Own elaboration. 2013. Own composition equal current liabilities times 100 over divided by third-party capital. End of description of Table 8. For every BRL 1.00 of third-party capital, the company has BRL cents as warranty. If the indicator presents a result lower than 1.0, the company will present financial dependence on third parties. By inverting the formula we will find the share capital quotient of third parties in equity, revealing the existing proportion of third-party capital and own capital, how much the company uses borrowed capital for each real of equity liquid. In this case, the smaller this indicator is, the better. It should be remembered that the lower the company's indebtedness, the greater your financial freedom to make decisions. Whenever the first index is greater than 1.0, there will be an excess of equity over third-party capital, which leads us to conclude that the second indicator, to present the same analysis, will have to present a result less than 1.0. 3.3 Profitability Indexes. Profitability indices measure how profitable the company is, that is, how much of resources is being generated. These indicators seek to show the return on capital invested, that is, the result of the operations carried out by an organization. Therefore, they are concerned about the economic situation of the company. With the accounting statements in hand, the company can build dozens of indices. However, it is the intended purpose that determines how many and which indices will be used. Assets, net margin, return on assets and return on equity. The asset turnover, specifically, shows how many times the company recovered the value of its asset through sales over a period of 1 year. He is quite dependent on the company's sector of activity, and its analysis must always be combined with the analysis of one or more margin indicators. A high asset turnover means the company is selling more. Table 9. Asset turnover source. Own elaboration. 2013. Asset turnover equals net sales over divided by asset. End of description of Table 9. 3.3 Profitability Indexes. Profitability indices measure how profitable the company is, that is, how much of resources is being generated. These indicators seek to show the return on capital invested, that is, the result of the operations carried out by an organization. Therefore, they are concerned about the economic situation of the company. With the accounting statements in hand, the company can build dozens of indices. However, it is the intended purpose that determines how many and which indices will be used. Assets, net margin, return on assets and return on equity. The asset turnover, specifically, shows how many times the company recovered the value of its asset through sales over a period of 1 year. He is quite dependent on the company's sector of activity, and its analysis must always be combined with the analysis of one or more margin indicators. A high asset turnover means the company is selling more. Table 9. Asset turnover source. Own elaboration. 2013. Asset turnover equals net sales over divided by asset. End of description of Table 9. Table 11. Net margin source. Own elaboration. 2013. Return on assets equals net income times 100 over divided by assets. End of description of Table 11. Return on assets measures how much profit the company makes for every $100 of total investment. For Matarazzo 2007, p. 179. The measure of the company's capacity to generate net profit and thus be able to capitalize. It is still a measure of performance year-to-year comparison of the company. Finally, the return on equity reports how much the company obtained from profit for every $100 of equity invested. Table 12. Return on shareholders' equity source. Own elaboration. 2013. Return on equity equals net income times 100 over / divided by equity. End of description of Table 12. to be sure that investments are making the desired returns or that at least they are not being applied in a wrong way. It is enough to assess whether they are being superior to other applications, because, according to Materasso 2008, p. 181, a role of the Return on Equity Index is to show which rate of return on equity. This rate can be compared with that of other alternative yields on the market, such as savings accounts, CDBs, bills, currency exchange, shares, leases, investment funds, etc. Companies are normally expected to provide higher returns than fixed income securities. However, having investments in the company represents risk capital. That is, nothing ensures that the company will be profitable at the end of the year. 3.4 Other relevant indexes. EVA, Economic Value Added, is a measure of business performance that seeks to include remuneration to the company's shareholders, as it demonstrates how much investment of the shareholders' capital would yield in other investments. For Crepaldi 2008, page 287. Includes a charge on earnings for the cost of all the capital that a company uses. It can also serve to measure the profit expected by shareholders. If they expect a minimum rate of return of 15% on their investment, they don't start making a profit until that goal is exceeded. EVA equals expected rate of return. Cost of capital * invested capital. EVA was created with the purpose of assessing whether, each year, the company is earning enough money to pay the cost of the capital it manages. EVA is a measure of true earnings. It is operating profit after payment of taxes less capital charges, suitable for both debt and equity capital. What remains is the amount by which profit exceeds or fails to reach the cost of capital used to realize that profit. Compensation on capital makes it clear that a business has to produce a minimum competitive return on all the capital invested in it, because in the same way which creditors demand their interest payments, shareholders insist on getting at least a minimum acceptable rate of return on the money they have invested in the company. Negative EVA does not necessarily mean that the company is on the brink of failure, bankruptcy, but it is a warning for businessmen to rethink their action strategies. If the capital invested in the company is not being remunerated at a minimum rate that compensates the risk involved in the business, in this case the best thing would be to reassess its performance, reallocate assets, idealize new products, seek new markets, or invest in more profitable projects. Another index is the EBITDA, is the English acronym for Earnings Before Interest, Taxes, Depreciation and Amortization, which translating into Portuguese means Earnings Before Interest, Taxes, Depreciation and Amortization. EBITDA is the adjusted net profit of the company. Thus, it represents net income before interest, taxes, depreciation and amortization. To arrive at the EBITDA of a company, the following calculation must be used. Net income for the year, minus expenses with interest, taxes, amortization, with depreciation equal to EBITDA. EBITDA represents the company's operating cash generation. That is, how much resources the company generates only in its operational activities, without taking into account consideration financial and tax effects. The use of EBITDA gains importance, because analyzing only the final result of the company profit or loss has often been insufficient to assess its real performance in a given period. as it is often influenced by factors that are difficult to be measured. You are on the Flor de Ouro channel Malik Nova. I wish you learning and extraordinary experiences. Article recorded on March 16, 2023 by Sybil Mann Baylor, for educational sharing in Flor de Ouro. Like and subscribe. For final considerations. The main objective of this article is to demonstrate some of the main analysis tools for the economic and financial performance of companies. The knowledge of the analytical methodologies of economic financial performance of the organizations. It is not enough to instruct the decision-making process. What really matters is the correct interpretation of the indexes obtained. Only with the correct interpretation of these data is that get efficient management. Financial planning will be better prepared if the company maintains an integrated accounting system, which makes it possible to query data at any time, accounting that will be analyzed before any managerial decision, which will be the basis of a safe and successful administration. In order to keep up with the needs posed by each day, it is necessary to adapt to new technologies. Accounting, in particular managerial accounting, due to its great degree of analysis, must always be present in companies' decisions. The indicators need to be, in addition to being understood, interrelated, as one analysis report must be integrated. It must show that the parts make up the whole and that only from the whole can we draw conclusions that will help in the process of decision-making. References: Share, Roger O. The Management of Small and Medium-Sized Companies, What to Know to Manage Them, 2nd edition ref. And Damp. Sao Paulo, Maltese, 1991. CREPLDI, Silvio Aparecido. Management Accounting, Theory and Practice. For said. Sao Paulo, Atlas, 2008. Marian, Jose Carlos. Analysis of Financial Statements, Business Accounting. 3.ed. Sao Paulo, Atlas, 2005. Matarazzo, Dandici Financial Analysis of Balance Sheets, Basic and Managerial Approach. 6. Said. Sao Paulo, Atlas, 2008. Oliveira, Marilis Amontoni D. Management Accounting, the Application in the Management of Microenterprises and Small Businesses. 2005. 71 F. Monography. University of Tobit. 2005. Padia the Easy Clovis Lewis. Management Accounting. 6. Said. Sao Paulo, Atlas, 2009. Pazzolato, Nalayo Dominguez. Introduction to Managerial Accounting. Sao Paulo, LTC, 2008. Santiago, Marlene Ferreira. The Effect of Taxation on the Financial Planning of Service Providers, a Case Study of Regional Development. 2006. 139 F. Master's Dissertation, University of Tobit, 2006. Silva, Daniel Salpalaya Rose. Micro and Small Accounting Procedures Manual Companies, 5th ed. Brasilia, CFC, SBRE, 2002. Presented on February 4, 2013. Approved on June 28, 2013.